Hi everyone, and welcome back to The Independent Dollar. Today's video is episode 1 in our subscriber series where we answer your most requested personal finance questions. If you have a question you would like featured in an upcoming video, we would love to hear from you. So comment below, or you can send us a confidential email to info@theindependentdollar.com. Today we're taking another look at our RSPs, but this time our anonymous subscriber asks, I have a line of credit that I want to pay off that I currently owe $10,000 on. I'm in my 30s and I make $75,000 a year. The interest rate is 10.45%. Does it make sense for me to cash out my RSP in order to pay it off? There are some situations where it can make sense to withdraw from your RSP early to pay down debt. However, this will depend on a few things: how much you need to withdraw, how much the debt is costing you each month, and your current level of income. And these are just a few things that you need to be considering. You should be really cautious though, because there are risks and potentially large costs to withdrawing from your RSP early in order to pay off debt. Let me show you what we mean. You're in your 30s and you make $75,000 a year. In order to pay off the line of credit, you need $10,000. Anytime you take money out of your RSP though, the full amount is added to your income for that year. So in this example, your taxable income now becomes $85,000 instead of $75,000. This means your income tax will now increase from $15,353 to $18,444. However, it doesn't end there. Financial institutions are required to withhold tax when you make a withdrawal from your RSP account, which means if you were to cash out $10,000, you're not actually going to get that full amount to pay off your line of credit. You're actually going to get closer to $8,000. Here's how that works. If you cash out up to $5,000 from your RSP, they withhold 10% for taxes. Anything over $5,000 and up to $15,000, they withhold 20%. And anything over $15,000, your financial institution will withhold 30% for taxes. This withheld amount gets paid to CRA and is then a credit for you at tax time. So essentially, it's like you're paying part of your taxes in advance. This means though, in order to get that full $10,000 that you need to pay off your line of credit after you've paid those withholding taxes, you need to actually withdraw $12,500. The full amount will be added to your income for the year, which now means your taxable income will increase from $75,000 to $87,500. Your taxes owing will also go up from $15,353 to $19,270, assuming you live in Ontario. With RRSPs, they're best withdrawn when you're in a lower income tax bracket, which is usually when you eventually retire. As you can see, withdrawing from your RSPs when you're still working can be quite expensive. In this case, the income tax cost alone will be almost $4,000, nearly half the amount owing on your line of credit. On top of that though, here are some things that you also want to keep in mind. When you take money out of your RSPs, that contribution room is lost forever. Also, you've lost any interest that could have been earned on that money over the next few years from now until retirement. Since your income will be higher, this also means a clawback or a reduction of any income-tested benefits, like the Canada Child Benefit if you have children. Here's another option that you could consider to get that line of credit paid off. Based on the balance and interest rate, your minimum payment is about $200 a month. If you can increase that amount to $325 though, or an extra $29 a week, you can have it fully paid in 3 years. On this plan, the interest cost will be about $1,700. During that same time though, if you earn about 5% in your RSP, that $12,500 that you would have had to withdraw could now grow to nearly $14,500. It will also stay invested and continue to grow even higher until you eventually retire. On top of that, you can now avoid paying $4,000 in taxes next year that will be due from cashing out your RSP. For this plan to work though, you need to stop making any other purchases on your line of credit until it's fully paid. You can actually ask your bank to set up this automatic monthly payment towards your line of credit on your behalf, so you don't need to remember to do this every month. If things financially change for you, it's just as easy to reduce the payment or cancel it if you do need extra money one month. Keep in mind that interest rates are at all-time low right now, so I would strongly suggest contacting your bank and requesting a review of your account to see if you can get a lower interest rate to help pay it off even faster. If you do all of your banking with them, or you have a mortgage with them, you are well within your right to ask for a lower rate for being such a loyal customer. If that monthly payment is a bit too high, putting together a budget to see how much you can comfortably pay down each month would be a big help. We have a really great video on ways to build a budget and also some great tips to cut down costs so you can become debt-free even faster. We'll include a link to those videos in the description below. You can also download a free budget template from our website, theindependentdollar.com, which lists a lot of great common expenses to help you get started. Hopefully you found this video helpful. Comment below if there's a topic, financial situation, or product you would like featured in one of our upcoming subscriber series videos. Thank you so much for watching, and we'll see you back here next week.